Hey friends, this is the second of several little videos I want to do over the chart of accounts and USALI. The chart of accounts isn't the most exciting topic, but it's where most of the differences in the hotel industry accounting stem from, and a lack of understanding of the chart of accounts is where we see a lot of mistakes made on the financial statements. So it's really important to get your chart of accounts right and for the team to understand it. So in the first video, we talked just generally about the chart of accounts and what it is, how the hotel chart differs from other industries, and where we find the standards for the hotel industry. In this video, we're going to learn more about the key considerations that you need to make when putting together your chart of accounts and how to know if it's time to revamp your chart of accounts. So the uniform system says that accounts can be removed if they aren't needed, but you shouldn't add new accounts unless they can be summarized into one of the standard USALI accounts or categories. Every hotel is going to be different though, and you are going to have specific needs for your hotels. You're going to have times when a new account is needed, or maybe even a new department is needed. And that's okay, that's to be expected. But I do want to caution you, when people start adjusting their chart of accounts, there can be some real pitfalls. And I've seen all of the ones we're about to discuss, and I don't want them to happen to you. Because remember, the chart of accounts is the foundation of your accounting system and the foundation of your financial statements. So if it isn't being used properly and it doesn't make sense, or your team just doesn't understand it, then your entire accounting system is compromised. Okay, did I scare you enough? I don't think I'm being overly dramatic here. I do want to make sure that I have your attention. Okay, so the first cautionary tale that I want to tell you about is having too many balance sheet accounts. The accountant should have backup documentation that explains the balance of every balance sheet account. But tons of hoteliers come to us with super long balance sheets and no clue what makes up the balances of many of those accounts. In my opinion, this is more likely to happen if a new account is created every time something new comes up. The key here is every balance sheet account created needs a schedule to back it up, and it needs to be reconciled every month. I think balance sheet backup and reconciliations will probably be another training that we do because it's so important and it often gets away from people. But for this video, just keep in mind, you don't want things to get lost on your balance sheet. It usually doesn't get the attention that the income statement gets, and you don't want things to hide there. So don't get too crazy adding accounts. All right, the second one is having too many inventory accounts. And yes, the inventory accounts are also on the balance sheet, but I want to highlight this one specifically. So many of these key considerations that we'll discuss are centered around what's actually practical for your hotel and your team. So when it comes to inventory, you have to think through what inventories are practical for our team to keep separated and to keep track of. You need to give it very careful consideration if you're considering having inventories for multiple outlets or inventories for specific types of items like a dairy inventory, poultry inventory, seafood inventory. If you have inventory accounts for individual outlets, make sure that it's reasonable to keep those inventories physically separated and to keep track of purchases separately. If you want to have separate inventories for different types of items, you need to make sure the amount of time that it will take your team to take those inventories is reasonable. Some select service hotels don't keep inventory at all. They may only have a small pantry or market and they just really don't need it. So make sure to stay practical with your inventory accounts and don't even create them if you don't need them. Number 3 is to have too many departments. So when I was building a chart of accounts for a client a few years ago, they were adamant that every food outlet have its own full-blown department. So that meant adding literally hundreds of accounts for this hotel to the chart of accounts, and at least 10 pages were added to the income statement. Now, that's not a bad thing if it's appropriate for the hotel's operations. It means that every food outlet was going to have a separate cost of sales, labor, and other expense section. So we went through all the questions to determine if it was really necessary for this hotel, and he was sure that it was. The hotel wasn't open yet, so I couldn't look at the activity and actually verify that. The problem was that the payroll report did not break down all the labor for every single food outlet by outlet. And the general manager who was coding the invoices didn't know which portion of the invoices should go to each individual outlet. And even the property management system didn't break down the revenue into the detail of the accounts that the client had asked me to create. So there ended up being pages and pages on the financial statement that weren't even really used. And income and expenses were kind of spread out throughout the departments willy-nilly. And I don't want to sound like I'm just whining, but it was a lot of work, and it would have been fine if it was worth it. But the bummer was because he didn't use it. It didn't serve him well. So if you want your financial statements to be as helpful as possible, you have to keep it practical. It's very important when you're creating accounts, and especially entire departments, that you know where the information is going to come from. Okay, so just in case you're multitasking, I'm going to say that again because it's really important. If you're going to make multiple food outlets, entire departments in your chart of accounts, you need to know where that information is going to come from. And you're prepared and you have the proper training in place. So again, let's go over some of those inputs. The PMS revenue has to be broken down at least into as much detail as you want in your chart of accounts. The payroll company has to have the ability to give you the wages broken down at least into as much detail as you want in your chart of accounts. And whoever's coding the accounts payable invoices has to be able to tell which expenses go in each department, every single one of those other expenses section. Okay, so those are the first 3 key considerations that you need to think through if you're going to make changes to your chart of accounts. In the next video that we'll release next week, we'll tackle several more key considerations in building and really understanding your chart of accounts so that you can make the most of it, so that your financials are helpful to you. It's totally doable. We just need to think through it one step at a time. All right, I hope that was helpful. I'll talk to you soon.
Thank you for watching this week's video. These videos are designed to help you build your team, make your financial statements even more helpful, and ultimately save you money. If you haven't signed up to receive these videos weekly, please do so below. And if you know someone who this would help, send it their way. All right, have a great day.